All right, let's dive into one of the most important accounting standards in the world. Today, we're breaking down IFRS 9, which is basically the official playbook for all financial instruments.
Just think about it for a second. A company's balance sheet is packed with everything from simple cash and receivables to incredibly complex derivatives. So, how on earth does anyone keep it all straight? How do you create one consistent picture of a company's financial health?
Well, that's where this single, powerful standard comes in IFRS 9. It's the universal rulebook that brings a sense of order to all that potential chaos, making sure everyone is playing the same game. Now, the best way to wrap your head around this standard is to treat it like a game plan, a playbook that covers the entire life of any financial instrument. So let's walk through it. First up, step 1, recognition. This is the very beginning, the moment an instrument officially makes its debut on a company's financial statements. The rule here is actually pretty straightforward. You record or recognize the instrument the second you're contractually locked in. And what's really crucial here is that this is all about the commitment date, not necessarily when money actually changes hands. So what does that actually look like? Well, for a simple trade receivable, it's the day the goods are delivered. But for something more complex, like a forward contract or an option, it happens the moment you sign on the dotted line, the commitment date itself. And now for step 2. This is where things get really interesting. Measurement. Okay, so the instrument is on the books, but how do you actually figure out what it's worth? For financial assets, IFRS 9 has this brilliant framework that basically boils everything down to just two powerful questions. First, you've got the business model test. This is the why. Why is the company holding this asset? Is it just to collect payments? Is it to sell it? Or maybe a bit of both? And second, there's the cash flow test. This is the what. What do the payments actually consist of? Are we talking simple principal and interest, or is there something more complicated going on? The answers to those two questions lead you right to this decision matrix, which is really the strategic heart of IFRS 9. If your business model is to hold an asset to collect simple payments, boom, you're in the amortized cost category. If you plan to both hold it and maybe sell it, it gets measured at fair value through other comprehensive income, or FVOCI. And for pretty much everything else, it just defaults to fair value through profit and loss, or FVTPL. Let's make that a little simpler. Think of amortized cost like a basic loan. All you care about is getting your principal and interest back. Fair value through OCI is more of a hybrid. You're collecting payments, sure, but you're also keeping an eye on the market price just in case you decide to sell. And fair value through profit and loss? That's kind of the default bucket, especially for things like trading stocks, where the daily market price is everything. Thankfully, after all that, when we turn to liabilities, things get a whole lot simpler. The vast majority of them are just measured at amortized cost. The main exceptions are for things like derivatives or liabilities you're actively trading. Okay, let's move on to step 3. The instrument is on the books, we know how to measure it, but what happens during its life? Well, this is where two key concepts come into play: impairment and reclassification. Now, IFRS 9 introduced a massive philosophical shift with its impairment model. Instead of waiting for a loss to actually happen, it forces companies to look into the future with its expected credit loss model. You have to account for losses you expect to happen, which was a huge change from the old rules. The way it works is kind of like a switch. If an asset has low credit risk, you only need to account for losses you expect over the next 12 months. But the moment that risk goes up significantly, a switch flips, and you have to recognize all the losses you expect over the asset's entire life. So you might be wondering, can I change the measurement category later on? Well, that's called reclassification, and under IFRS 9, it is extremely rare. It can only happen if a company totally overhauls its business model for managing those assets. And as for financial liabilities, simple. They are never, ever reclassified. And that brings us to our final step in the playbook, derecognition. This is the exit stage, when an instrument's journey comes to an end and it comes off the balance sheet for good. For an asset, the exit happens for one of two reasons. Either the contract just runs out and expires, or you transfer your rights to the cash flows to someone else, like when you sell a receivable. For a liability, the conditions are just as clear-cut. It's gone when the obligation is paid off, canceled, or it expires. But there's also this really important quantitative test. If you modify the terms of a liability and the present value of its cash flows changes by more than 10%, you have to de-recognize the old one and recognize a brand new one.
So we've made it through the entire playbook. Let's pull it all together into one final checklist you can apply to just about any financial instrument you come across.
Really, it all boils down to these 5 questions that cover the whole life cycle. First, is it even a financial instrument? Then, when do we recognize it? How do we measure it? Has its credit risk changed enough for an impairment? And finally, is it time to take it off the books?
And that's the real power of IFRS 9. It's not just a dense collection of rules. It's a logical framework. It's a playbook that gives you a clear and consistent path to follow from start to finish.
So if you only take one thing away from this, let it be this. If you can answer those 2 fundamental questions, why is the company holding this, and what do its cash flows look like, you've pretty much unlocked the logic behind every major decision in IFRS 9.
And all of this leaves us with one last big question to think about. When a standard relies so heavily on management's intent and their predictions about the future, where does that put us? Is modern accounting still a precise science, or is it becoming something more like a judgment-based art?